Hi everyone, this is Asa Bailey for Invest and Recover. Today we're going to talk about risk. Everything in life has some degree of risk associated with it. Leaving home in this COVID time puts you at further risk. I always say risk is not a bad word. What really matters is your understanding of risks and how you respond to mitigate it. Your finances are also subject to risks. Our primary financial risk is not having enough money to achieve our goals in the long term. Specifically, I want us to talk about your risk profile. What is risk? Risk is the probability or likelihood of occurrence of losses related to the expected return on any particular investment. In simple terms, it is the chance that an investment will decrease in value. This thought will cause some jitters if you guys are risk averse, meaning you are unwilling to take risks or wanting to avoid risks as much as possible. Mark Zuckerberg said, "The biggest risk is not taking any risk." In a world that's changing real quickly, the only strategy that is guaranteed to fail is not taking risks. Before we can draw up your risk profile, I would have to find out your level of experience in investing, your risk tolerance, goals, and investment horizon. How much cash will you need to keep for yourself for regular expenses? You will need to consider reserving some in case of an emergency. What's your age? What's your income? That is quite a bit of information for you to divulge, but it is very important. No investment is entirely without risk. When you invest, you want to know upfront how soon you can get back your money when you need it, how fast can we get this investment thing working for you, and is the product that we're invested in safe enough? Quite often, we do not fully understand the risks associated with our particular investment. We're going to use a scenario. Donald got a bonus of $100,000 in December 2018, and with excitement he called up the advisor that had been encouraging him to invest for the longest while. They had a discussion and they decided that based on his investment objectives and risk appetite, it is best for him to start with a unit trust account, one that was invested in a pool of mainly blue chip stocks on the stock exchange. Donald also decided to add $10,000 monthly to his original investment of $100,000. This investment grew well, and at the 3 months review, the advisor was careful to remind Donald that his investment account, though it is growing well, it was vulnerable to market risks, where his account may decrease in value due to unusual economic events, but if he remained in it long term, he would realize the best earning. And specifically the equity risks, which is the risk of loss because of a drop in the market price of his shares. Donald's response was, "I'm investing long term. This is for my retirement. I fully understand. And I am prepared for the upward and downward swings in my investment to realize the maximum returns in the long term." In all, Donald contributed $220,000. At the end of December 2019, which is 1 year, Donald realized that his investment of $220,000 grew by 29%, which works out to be $53,808. When you add that to his original investment, his total value grew to $273,808.42. Donald is taking an aggressive approach toward his investment, and it worked relatively well for him in 2019. That's Donald. He was investing long term and views risk differently from how some of us might be viewing it. What is your risk preference? How willing and able are you to assume the possible risks associated with an investment? Navigating these difficult financial times, we must understand the risk associated with an investment, the nature of the asset that you're invested in, and how time affects the total value. The general rule is, the higher the risk, the higher the potential return. The lower the risk, the lower the potential return. If your primary purpose for investing is for capital protection, or you do not have an income, you may want to consider taking a conservative approach to investing. This is usually for persons with a low tolerance for risk. You may realize that the returns on your investment are low as you invest in money market funds and certificates of deposit. On review, you may feel the urge to adjust your risk outlook. It might not be the smartest thing to do unless you wish for more growth in your capital and wish to access these funds beyond 3 years. If you have a moderate risk preference, meaning that you have a medium tolerance for risk in your investment and you desire capital growth, an investment grade bond may just be the option that you are looking for. You should only take this option on if you can manage some ups and downs in your investment, but not too much. There are others out there like you who are hoping for a higher return and are prepared to invest for 5 years or more. Every now and then someone asks me, please show me a way to double my money. If any of you knew a guaranteed way, then maybe you would not be watching right now. A few IPOs that I'm aware of have doubled in value. However, for every one of these doubled opportunities, there are hundreds of failed ones. The aggressive investor like Donald has a high tolerance for risk in investing. He is willing to invest for 10 years or more. He can afford to see his money dip by substantial amounts in the short term and still don't have a heart attack. Investors like Donald are hoping that they will be getting the largest possible return in exchange for accepting the associated level of risk. If that is you, then the aggressive approach is the way to go. There are many risk profiling systems online that you can try out. But let me help you identify your risk profile. We're going to do a calculation based on general stage in life. You calculate it. This might vary according to your unique circumstance. Where are you in life? Are you young, middle-aged, or senior? Have you just started working? The young person starts out with small wages, no assets, and sometimes no expenses. Her ability and willingness to take on risks are high, but she has time to recover in the event of a loss. The middle-aged person starts to invest and has the income to top up her investment, but then her assets and expenses are growing as well. Her ability to take on risk slides from high to low. Children and other expenses come into place, mortgage and other obligations. Shifting some money from stocks to government or corporate bonds is one way to balance things. When you're finally at the retirement stage, the senior person, well, we hope that you had invested enough because you no longer get a salary and your investment is now your main source of income. We would also hope that your expenses would have reduced and you're taking a conservative approach to your investment. Your money should be in the least risky investment, mostly cash or cash equivalents, as you cannot expose yourself to too much risk at this stage. I'm not saying that you should not have a little stocks in your portfolio. In these days, persons live some 20 to 40 years beyond normal retirement age, and they will need some part of their investment earning above the rising cost of living. No matter what age you are, you need to be reviewing your investment to keep a pace of things. In the end, you'll realize that the so-called risky investments, usually these are the ones that are more rewarding over the long run. You need to know your tolerance for risk. How much psychologically can you endure the potential of losing money on an investment? How much risk can you afford to take on? How much risk do you need to take on? We hope to be in a better position financially where we can take on a moderate or a high risk approach and go long term for growth in the value of our investment. But it boils down to our current position and the main objective that we are hoping to achieve. There's a mass of information available regarding investments that you are interested in and tools out there that you can use to better understand your preference. Appreciating this information, you will find that it will help to influence your preference. This is a stage in life that you will need an investment advisor. We almost forgot Donald. He had an investor. He contributed $220,000 from January to December 2019, and he earned 29%, and his money grew to $273,800 by December of that same year. So in January 2020, he continued with the same amount, but his work situation changed and he could not add to his unit trust investment monthly. By the end of March, his account balance drops to 213,570. His investment lost value by 22% or 60,000, but this will rebound. There is no broad brush approach to creating, preserving, and growing wealth, but there's a way to put into perspective the related market and equity risks, assessing your risk profile, and taking on an approach to your investment. The risk profile is very important. It identifies your willingness and ability to assume risk. It helps to create a proper allocation for your investment portfolio. It helps to mitigate the potential risks and determine how much risk is appropriate for your financial plan. The safer the investment is the lower the return. I know some of you have gone extremely conservative since the crisis and are reconsidering things as we discuss right now. But with another mindset, some of us are on the aggressive path and ready to take on the market with low prices. The local stock exchange is doing well relative to the performance of other markets internationally. So I'd say invest more. With experience, your risk preference will change. Next time, we take a close look at investment options available in the market. This is Asa Bailey. Thank you for tuning in again to Series in Invest and Recover. Stay safe. Remember to subscribe, like, and share, and leave your comments below. Take care.